In venture capital, where you invest matters just as much as what you invest in, some funds focus on local ecosystems, betting on startups within a specific region or country, while others take a global approach, backing high potential founders wherever they emerge. Each strategy comes with its own opportunities, risks, and competitive advantages. While local VCs can leverage deep market knowledge and strong founder relationships, global investors gain access to a broader talent pool, diversified markets, and international scaling opportunities. So, how do VCs decide whether to focus locally or invest globally? Let's break down the trade-offs. Many venture capital firms focus on specific geographic regions, such as Silicon Valley, London, Berlin, or emerging markets like Southeast Asia and Latin America. This localized approach allows investors to develop deep market expertise, build strong relationships with founders, and gain early access to promising deals. One of the primary advantages of local investing is the ability to foster closer relationships with founders. Proximity makes it easier for investors to engage with startups, mentor teams, and participate actively in board meetings, ultimately strengthening trust and collaboration. Local investors also gain a deeper understanding of the regulatory landscape, cultural nuances, and business environment, which gives them a strategic edge when evaluating investment opportunities. In certain regions, government incentives, grants, and corporate partnerships create additional advantages for locally based venture firms. Moreover, the presence of strong local ecosystems, including accelerators, universities, and startup communities, enables investors to tap into a steady pipeline of talent and rising entrepreneurial ventures. However, local investing also comes with challenges. A geographically focused approach can limit the diversity and quantity of deal flow compared to funds with a broader international reach. In highly competitive markets like Silicon Valley or London, venture firms face intense competition for deals, leading to higher valuations and potentially lower returns. Additionally, being tied to a single region can expose funds to localized economic cycles, meaning that an economic downturn or recession in that specific area could have a disproportionate impact on the portfolio's overall performance. Global venture capital firms adopt a borderless investment strategy, seeking opportunities beyond their home markets. By doing so, they can capitalize on emerging economies, diversify risk across different regions, and access exceptional talent that local investors might overlook. This approach allows them to invest in the best startups, regardless of where they originate, giving them exposure to a broader range of high-potential opportunities. One of the key advantages of global investing is the ability to tap into a much larger deal pipeline. Rather than being restricted to a single market, a global fund can identify and invest in startups across multiple ecosystems, ensuring that it never misses out on breakthrough innovations. Diversification across geographies also helps mitigate risk. If one region faces economic difficulties, other markets may continue to thrive, balancing overall portfolio performance. Moreover, investing globally enables venture firms to capture growth in emerging markets, where startups in regions such as India, Africa, Latin America, and Southeast Asia are rapidly expanding. These areas often experience lower competition from venture capital firms compared to established markets like the US and Europe. Additionally, global investors play a key role in supporting startups as they scale internationally, connecting them with investors, customers, and business partners across different regions. However, global investing comes with its own set of challenges. Managing a portfolio that spans multiple countries presents logistical difficulties, as startups in different regions require varying levels of support, market expertise, and legal navigation. Cross-border investments also introduce regulatory and political risks, requiring firms to stay informed on varying tax laws, trade policies, and data privacy regulations in each jurisdiction. Additionally, global funds often face competitive disadvantages when entering local markets, as founders may prefer working with investors who are physically close and deeply embedded in the regional ecosystem. Despite these complexities, firms that successfully execute a global investment strategy gain access to a wealth of opportunities that regional funds may miss. By leveraging their international networks and capitalizing on geographic diversification, they can position themselves as key players in the rapidly evolving global startup landscape. Most venture capital firms do not strictly adhere to a local or global strategy. Instead, they assess their strengths and determine the best geographic focus based on where they can add the most value. Choosing the right geographic strategy involves a careful balance of expertise, competitive positioning, and long-term potential for returns. One of the first considerations is whether the firm has a competitive advantage in a specific region. If a VC firm possesses deep local expertise, strong government ties, or an established network of founders, it may opt to concentrate on that market rather than expanding globally. This localized approach allows firms to leverage their insights and relationships to gain early access to top deals and offer hands-on support to portfolio companies. Beyond simply providing capital, successful investors evaluate whether they can add meaningful value to startups in a given market. In global investments, VCs must offer more than just funding. They need to provide strategic connections, facilitate international partnerships, and support companies in securing follow-on funding. The ability to help startups navigate cross-border growth and expansion is often a key differentiator for firms operating on an international scale. Another crucial factor is the attractiveness of a market for future exits. A region's ability to support IPOs or sustain strong M&A activity plays a significant role in a VC firm's decision-making process. If a market lacks a well-developed exit landscape, liquidity may be more difficult to achieve, potentially affecting returns for investors. Competition within the local VC scene is also an important consideration. In heavily saturated ecosystems like Silicon Valley, where an abundance of venture capital results in higher valuations and fierce competition for deals, some firms look to emerging markets where they can find high-potential startups at more reasonable valuations. Identifying markets with the right balance of opportunity, competition, and long-term scalability is key to executing a successful geographic investment strategy. Some of the most successful venture capital firms operate with a hybrid strategy, blending global investment reach with localized execution. Rather than committing solely to either a local or global strategy, these firms establish investment teams in key markets while leveraging insights from multiple regions. This model allows them to combine the advantages of both approaches, accessing the best global opportunities while maintaining deep connections with local founders and business ecosystems. The strength of the hybrid model lies in its ability to integrate broad market insights with localized decision-making. Firms with this approach can leverage global trends and investment patterns while tailoring their strategies to the specific needs of each region. It allows them to tap into fast-growing markets without losing the depth of understanding that comes from being embedded in a local ecosystem. Additionally, by balancing exposure across multiple economies and industries, they can mitigate risks associated with market downturns in any single region. As startups become increasingly borderless, venture capital is evolving into a more globalized industry. Investors recognize that the next billion-dollar company could emerge from anywhere, whether in Silicon Valley, Berlin, Bangalore, or Lagos. However, successful venture investing is not just about having a global perspective. It is about executing well in specific markets. The most effective VC firms combine broad market vision with deep local expertise, ensuring that they can provide meaningful support to the founders they back. At the end of the day, whether investing locally or globally, the key to success in venture capital is not just about deploying capital. The firms that make the biggest impact are those that help startups scale in the right markets at the right time, bridging the gap between global opportunities and localized execution.